Good morning, all. I'm Richard Calhoun, a real estate broker here in Silicon Valley for the last 40 years, working with buyers and sellers. Happy to help you in your biggest decision. We're here today to talk about the local real estate market conditions. There's a few URLs that will be helpful for you. The root URL is shown here in green, tiny URL /RE market graphs, and then you add on different suffixes to get to different places. The 4-year digit code gets you to this meeting live. If you want today's handout, you add the word handout and the full 8-digit code 2021-02-13. That gives you about 25-page slide handout. To get to the archives, you just do the root URL, and then to get to the specific issue, you add the 8-digit code. For those that are returning, this slide is normally down several. I do not have my 3 map grids, and that's because of the change with the MLS. There's just a lot of changes I have to make that I have not made it through it all yet. But here what we're looking at is days of unsold inventory. This to me is the single biggest indicator of what the marketplace is doing. The second vertical purple line is when shelter in place was announced, and you can see on the blue line the data, the huge impact last year. The first one is week 6. That's where we are right now. So from that point right here on the purple back to the left, this is actually 21 data. From the first purple line to the right is 2020 data. So the transition is between week 6 and week 7, which is why it potentially jumps up. But you can see that's also where the gold line goes. So what do you have? You have the blue line, this year's data, days of unsold inventory, compared to the 5-year median of days of unsold inventory. The 5 years that I am using are 2015 through 2019, which were 5 normal but fantastic years. So when the days of unsold inventory is right on top of the 5-year median, we're having a fantastic year. What do I expect to have going forward? Well, I expect it to actually stay down on the golden line this year. I do not expect to have a big disturbance from shelter in place being announced. So I'd expect it to stay down and very aggressive. In general, I believe anything below 40 days of unsold inventory is a very strong seller's marketplace. And so we're down here in the low 20s. That's an extremely fast marketplace. Between 40 and 80 is the balanced marketplace, and above 80 is where you start getting into a buyer's marketplace. So now that's the macro, which is single family condo townhouses in both San Mateo and Santa Clara County. Let's break down and look at where the hot spots are and the slow spots. So the hot spot is in Santa Clara County. What you have, it's pretty straightforward. You take your inventory, divide it by the number of offers. The top line is in the last 1 week. So that tells you what's happening right now today. The second line is 5 weeks, and that gives you a little bit more stability to get rid of some of the statistical fluctuation you see. So in Santa Clara County single family homes, we only have 20.6 days of unsold inventory based on the activity of this past week. Based on 5 weeks, we're at 21.7. Both of those are extremely low, extremely aggressive marketplaces. You jump over to San Mateo County and they're higher. So 26.5 and 29.6, still very aggressive marketplaces, but also significantly slower than Santa Clara County. And that's reverse of normal. I believe that's an impact of COVID. People aren't willing to pay the premium to be in San Mateo County. They're willing to commute into Santa Clara County, get a little bit bigger house for their money because they're spending more time in their home. And then the first column here is them both combined. So this number here tells you the overall. This gives you the breakdown between the two, which tells you Santa Clara County is doing better than San Mateo County. And this is the number completely combined of all 4 components. Then same concept over on condos and townhouses. And right off the bat, you'll notice that they're doing significantly worse, especially San Mateo County condos. We're at 41.8 and 41.3 days of unsold inventory. So that's still a fairly good marketplace, but that's at the bottom of what I would start calling a balanced marketplace. And that's, again, I think it's all related to COVID. People need a little bit more space. They want a little bit more privacy. So you can see there's a doubling between single family homes in Santa Clara County and condo and townhouses in San Mateo County. And the reason this is important is a lot of people, like the media, talks about the Bay Area real estate market, which is combining 9 counties that touch the Bay, both types of property, and putting it into a blender. That kind of product does not exist out there. So I think you do need to look at it at somewhat more granular level. Now what we're doing is we're comparing 2 components to that 5-year median. The two components are supply and demand, which makes up the days of unsold inventory. We'll look at two different components of supply. One is the blue line, which is the total available inventory. And right now you're sitting there at 140%. And the first concept is if you have 100%, 40% more inventory than you normally do, the market should be slowing. It should be, but if you move over to the second component, sort of the rust color line, it's sitting here at also 40%. So you have 40% more buyers, 40% more sellers. It's staying in balance. It is noteworthy that if you come over here late last year, you're somewhere around 30, you're under 40, maybe 30%. One, there's a week change, so there's some change in the data. Part of what happened here is with the MLS Alliance, we're now getting data from all 7 MLSs in Northern California. Some of them are duplicate listings. Some of them are listings that weren't shown on the local MLS. So we're not comparing apples and apples, which is really unfortunate because now when you go back and compare to the 5-year median, you would expect more inventory this year just because of the change in the MLS. It's something I just have to deal with. I'm trying to get a handle on that. The other gray line that we haven't talked about is the number of new listings in the given week. And it's actually a little bit lower than the 40%, not significantly. You have a major dip down here last week for the holiday, which I guess was more, actually, that wasn't a holiday last week. This is a holiday, President's Day, and Martin Luther King's birthday was a couple days back, weeks back. Anyway, there was a dip last week, which is part of the fluctuation you get week to week. And you can see the gray line fluctuates quite a bit more than when you're looking at either the, like the 5-year median, because you've averaged it out over 5 years. Now moving on to total active inventory. My total active inventory is different than most people's. Most people include listings that the listing agent wants backup offers. I do not, because a buyer really can't come in and buy that property without first getting rid of the first buyer. Very few agents show those properties. They're basically a waste of time. So I only look at available listings with no underlying contract. And the concept is the same. The gold line is where you'd expect it to be based on the 5-year median. The blue line is where you are. So we have significantly more inventory. The previous chart told us about 40% more inventory. And that's up from last year over here where the difference was maybe about 20 or 30%. Part of that 20% increase is the MLS. I think that's roughly 10%. So I'm not too worried about anything. The huge jump on this first line is this is 21 data here. This is 2020 data. So there's a year difference. I'm thinking about in the future splitting the line between the two. So it's at the break point, not on the last data point of this year. Now we're looking at the number of new listings, way more fluctuation. The total inventory that we were just looking at is sort of the height of the reservoir, and the height of the reservoir doesn't change very rapidly. This is the amount of new water coming in, and you have a rainstorm like today, and the amount of rain coming into the reservoir is up significantly. If we have sunny weather next week, it'll be down. So there's a lot more fluctuation from week to week. Again, more than you expect, nothing outrageous, nothing significant. I'm not expecting this huge drop that we saw last year with shelter in place. In general, I'd expect it to follow along the gold line, and I'd expect it to be above the gold line based on the merging of the MLSs and the fact that there's more inventory. Basically, the consumers are saying their old housing needs, whatever they were, have changed, and that's brought a lot of people into the marketplace. We also have something coming up pretty soon that's going to start impacting the marketplace right now, and that's April 1st. Starting April 1st, people over 55 can move their low property tax basis 3 times and only add the incremental value to it. So if you're over 55 and you go from $1.5 million house up to 1.75, you keep your old property tax plus add that $250,000 increase to get a blended rate. So I think that's going to bring a lot of people out of the woodwork. You also can transfer down and keep 100% of your old tax basis to all 58 counties. Up until now, it's been limited to something around 10 counties. So that's going to cause a lot of people, I believe, to start moving into retirement homes and that kind of thing. Now we're looking at the other side of the equation, the demand side, the number of new offers. So the gold line is the 5-year median. The blue line is where we are this year. So we're significantly above. So we're having a lot more activity. We have more listings. We have more activity. Again, that's just people needing to move because of the shelter in place. I don't expect this valley to happen this year. So I'd expect it to follow, and I'd expect it to be somewhere around 30, 40% above the gold line, sort of like it was doing at the end of last year, but at a larger degree. Now we're looking at the number of closings. This is harder to see any data trends because closings happen over short, quick closes, long closes, so they sort of hide and blend market trends. But again, you can see the number of closings is above what you'd expect it to be, and I'd expect that to continue. Again, it's interesting, these wild spikes in the closings. I would not expect this in the data. There's some wildness that's going on that I don't understand. I don't think it's significant, but it's just interesting. And that's, statistical fluctuations. Some of it is the month ends, but these 2 month ends are too close together, 1, 2, 3 weeks. And there's going to be at least 4 weeks for month end. So just fluctuation, nothing really to explain on it. This is expired listings. It's new listings that expired, but what's interesting is the MLS of a listing expires and then is relisted, and the agent that relists it's the same agent. More likely than not, they're going to use the old MLS number, and therefore it no longer counts as an expired listings. And that's why I crossed out the word new. It's the number of expired listings for that week, adjusted for any that come back onto the marketplace. You can see we had huge spikes last year. At this point, I thought they were going to go away, but they showed up again at the end of the year, especially at the end of the year. We were off the top of the chart, and it's continuing. So we're having more expirations, which really doesn't make a whole lot of sense in a hot marketplace. But basically what you have is you have two different markets. You have the sellers that have a hot product and their property flies off the marketplace with a multiple offers, et cetera, or you have other products for whatever reason are not attractive and they stay and the seller gives up. This is canceled listings, sort of the same concept, but you either let the listing run for the full time. A canceled listing is a listing that comes off the market before the end of the listing agreement. Again, last year it was pretty close to the normal, a little bit above here at the end. That just reflects the extra inventory we had. We're starting off higher this year. It's a little bit surprising that we're this high at this time of the year. Some of these may be listings that actually have been around for a full year, which is sort of the longest people take listings for. So I'm interested to see what happens after starting in week number 11, after shelter in place, because then you'll no longer have any listings. And it'll happen before that because people that were going to go on the market didn't go on the market. So, basically maybe starting at week 9, which is only 3 weeks away from now, I expect the number of canceled listings to be reduced, but time will tell. Withdrawn listings, there is no history on this because once an expiration date is reached on a withdrawn listing, it then counts as an expired listing, which increases expired listings but decreases the withdrawn listings. But again, all these numbers have been fairly low in magnitude. If you're talking about 1,500 homes in the macro area, and you're only talking about 30 that are withdrawn and 30 that expired, it really is a small percentage of the marketplace. Now we're flipping over to the overbidding. Overbidding is good as it tells you what the buyers are sensing. Are they sensing a huge need to be attractive in their offers, or are there a lot of properties available and they don't have to be? So this first overbidding slide is what we call the frequency of overbidding. How common is overbidding? And right now you can basically see we're at 65% of overbidding happening, which is a pretty high number. The highest number we've ever had is 80%. The first purple line is basically we're in week number 6. So to the left of the purple line is 2021 data. To the right of the purple line is 2020 data. So instead of putting the data over here, I flipped it back over, and that's because I want to compare it to the same 5-year median. So for the first 6 data points of this graph, or 2021 data points, the line number 7 starting here on to the right is 2020 data. So frequency of overbidding is just how common is the overbidding. I'm just noticing right now, this red should probably come all the way down to 50%. And I will correct that, because once you hit 50% of the sellers getting more than their asking price, you're in a red hot marketplace. The blue is in about the right place at 33%. Those are just benchmarks I use. I don't know how it got up to somewhere around 43%, 73%. Now we're looking at the magnitude of overbidding. The shading is in about the right place. Basically, at 99% of the list price, you're in a cool marketplace. At 101.5% and above, you're into a strong seller's marketplace. So right now we're at 104%. Where do I expect this line to be? I expect this line to be above last year. And the reason I expect that is shelter in place was a major hit to the psyche of the buyers, and they're conservative and they don't know what's happening. And so when they're conservative and don't know what's happening, they pull back on their prices they're willing to offer. And so the overbidding went way down, but gradually they came up. And the magnitude of overbidding, how much they were overbidding, is disproportionately low compared to the frequency. So in my opinion, right now is a time for listing agents to price properties very close to market value. And I do know there are some people out there that price properties 25% under the marketplace. Yes, they sell the property quick. Yes, they get a ton of people through the properties. I actually think they leave money on the table, because if you take a rounding number, say the property is worth $1 million and you go on the market at 750,000, that buyer may only bid up to 950,000, where if you went out at 900,000, then they might pay up to 975 or $1,025,000. And if you went out right at $1 million, you might find someone paying $1,025,000, $1,050,000. That's just for illustration purposes. All it takes is two aggressive buyers and you get the market value. Buyers get hesitant. They're not, there's very few buyers that are willing to pay 50 and 60% over the asking price. Yes, it does happen. I've seen 200% of the asking price, double the asking price, but it doesn't happen that often. The bulk of the buyers pull down. So in my opinion, it's a balancing act between how far below market value you get to maximize this overall sale price. But the bottom line is anytime you're at 104%, you're pretty good. We've been up to 112%, so we have a long way to go. I think as we get further past COVID, especially as people, if we get vaccinated and things like that, and if the vaccine really seems to be working against the new variants and people have confidence, then I think the overbidding will increase fairly significantly. This is the overbid distribution. Here, each line is a different week. I have taken off January, the best January and the worst January, or February, depending on what I think is better. But I left on the best month ever, which was April of 2018, and the worst month ever, which was December of 2001. So you can sort of see the range of where these lines would be. The dotted lines are the oldest lines, the dashed lines are the next oldest, and then the solid lines are the newest, with the red line being the current line. So you can see that right now, the current week, we've had the best overbidding, which, guess that's going back 5 weeks, but I think it's going to continue. What is surprising, in my opinion, on here is some of the fluctuation, and I'm just going to guess, but this looks like it's January 2nd data here. This is January 16th data. So from the 1st to the 16th to the 20 to the 6th of February to the 13th, there's a lot of moving up and down versus in one direction. And it's a little surprising to see that kind of range. In other words, the current data, the red line, is the best recent week. And coming back here to, looks like January 2nd was the worst, and all the lines are in between that. I would expect general progression one way or the other. Again, this is weekly fluctuation. One of the reasons I'm having a major debate with myself on whether I'm going to start doing 5 weeks worth of data to get rid of that fluctuation. Here is just latest data points so you can see it. Again, the same pattern. The dotted lines are the oldest, the dashed lines are the next oldest, and then the solid lines are the most recent. So here, if you look at it, you can go, here is week, well, let's go in week order. So here is January 23rd. Okay, so January 23rd looks like it was the second best week. Then you go to the gray line, January 30th, which was the worst week. Then you go to February 6th, which is the second worst week. And then you go to this week, which is the best. So you can see that there, in the last 4 weeks, again, there's been a lot of fluctuation. Not what I would expect in a well-behaved marketplace. I think what's going on as part of this is a shift between single family homes and condos. Part of it is just the sample size at the end of the year is so small. I think we're only talking about 200 homes, and that is a pretty small sample size when you're talking about 2 counties and both types of properties. Again, with that, I'll pause a little bit and show the history, see if anyone's got any other questions they want to ask before I proceed with monthly data. Now we're shifting gears a little bit and looking at monthly data. And with the monthly data, we go back in time. So the highlighted rows are what I consider to be the critical data points. So the first one is inventory, and at 538, you're clearly on the low side. There's been a lot higher, 4,000 listings at this time of the year for back here when we were in a slow marketplace in the recession of 2007. The lowest year was 2018, which was basically our best year, our most aggressive year. 538, I think, is probably the second lowest, looking at it real quick, basically equal to last year at 543. There's no difference in the market performance between that with 5 homes. That's 1%. But there is a difference between that and 800 or 600 and 600 or 700. So, again, that says we have limited inventory in single family homes in Santa Clara County. And that's all this is. This is now ignoring San Mateo County, and it's ignoring condos and townhouses. And the concept here is we want to go back and look at what's happening a little bit historically. It's tough to do that on all the lines, on all the different types of properties. And Santa Clara County single family homes is the biggest micro market, and that's why it gets selected. Now moving on to days of unsold, days on the market. This becomes interesting in the fact that there's two almost contradictory things here. The average days on market and median. Median says that half the homes are selling within 8 days of being placed on the MLS. That's 1 week. That's basically as soon as the seller is willing to accept an offer, the 50% of the homes are gone. The other number is average, and at 27, that's 3 times higher. How can you explain that difference? It's a piece of cake. There are two different types of properties. One that's priced correctly and is going to sell immediately, and what we call in the industry overpriced turkeys. For whatever reason, it's priced too high to attract buyers, and they sit on the market for a long time. But the important part here is once you're past even 1 week, so call it, be generous. After 2 weeks, if you have not sold your house in this type of a marketplace, you need to do a price or a condition adjustment. There's something wrong. The buyers are rejecting your property. Days of unsold inventory, the purple line, that's the most important one. You're at 22 days of unsold inventory. If you look, we're outperforming 2018, which is unbelievable, because when that happened, I told you we would never have another, basically July, August 2017 through about April of 2018. And here we are outperforming 2017-18. And I never thought that would happen. And you just look back in time, there's nothing that low. The 23 was the lowest. Before that, it was basically around 30. So that just gives you a concept of how aggressive this marketplace is. Now we're looking at the deep red line. That's how many homes have we sold in the last 5 weeks. We've sold 859 homes. Again, that's pretty high compared to recent weeks. But if you go back historically, it's low. And that's one of the things that's been happening in Silicon Valley. We've been selling fewer and fewer homes year after year after year. And I believe part of the reason for that is the concept of Prop 13. With Prop 13, people were forced to, not forced, but they had a huge incentive to stay in their house for a long period of time because they were saving on property tax. Now that we're past April 1st, there's a good chance that they'll be able to move that with them. So going back to DUI, days of unsold inventory, that's simply how rapidly would it take to sell all the existing inventory at the current rate of sales. So if you have, go up here, you have 538 properties on the market. If you were selling 54 homes a day, you would sell that out in 10 days. So what we're doing is we're saying we're selling it out in 22 days. So we're roughly half of that. So we're selling 24 and a half homes. So basically, if you take inventory divided by your sales per day, then you get your days of unsold inventory. And hopefully my math does work out there. It comes close. So basically, if you take 24 and a half and multiply it by 22, you should get 538, or at least some approximation. And the reason I say some approximation, this is a live database. So when I grab the inventory and then I come back and grab the offers, the database has actually changed a little bit. So it can change a small amount. Then we jump down and we start looking at the overbidding that I was talking about. The first one is the sort of the paler red line, is the magnitude of overbidding. And at 104%, you can see it's quite a bit lower than the 108% that we saw in 2018. And that's something I would normally not expect. With the lower DUI now than in 2018, I would expect this overbidding to actually be higher than 108.5%. And the reason it's not is because of shelter in place. It's that consumer not willing to overbid. So even though the market is aggressive right now, we're being capped about 5%, if not 6% of the overbidding because buyers are remembering what happened less than a year ago. And so that's, interesting. There's not going to be necessarily a one-to-one correspondence, but that is what you'd expect. Now, if you look at the frequency of overbidding, you're at 63% versus 73. Why is that? Part of it is your single family homes right along the San Mateo County border, like Palo Alto, Los Altos, are in less demand right now. So those are homes are selling under asking price. That brings your sale price to list price ratio down. In 2017 and 18, which was the 73%, we had the market firing on all cylinders across the valley. We had no place pulling it down. That also impacts your magnitude overbidding too a little bit. Then the green stuff is the dollars. Most people follow the median price, which is the middle one. I tend to follow, well, I don't tend to, I follow the 10 percentile and the 90 percentile also. That gives you a sandwich. So basically what it says is 80% of the homes, because if you take 90%, subtract 10, that's 80% of the homes. 80% of the homes are basically between almost $900,000 and $2.5 million. So in that $1.6 million range, roughly, is where 80% of the single family homes in Santa Clara County work. So even though we talk about these high priced homes, in fact, I was noticing there was a home that sold in Santa Clara. I think it was in Santa Clara County. It was either in Santa Clara County or San Mateo County for $35 million. So you clearly have a few of those, but the bulk of the homes are in a very tight price range. Now we're looking at days unsold plotted. Days unsold inventory is the blue line here, which is the most significant. And right off the bat, what caught my attention was this little clip up here at the end of the year. But if you look back, last year there was the same click up. The year before there was one. 3 years ago there was one. There wasn't 4 years ago because that was the when we were really just improving dramatically. But if you keep going back, click up. So those are seasonal adjustments that you have to realize. And again, whether it's here at 22 or if it's down here at 21, doesn't make a difference. What makes a difference is above or below the red line. Below the red line is a strong seller's marketplace. Between the red and the blue is the balanced marketplace. And it doesn't go from red hot just below to balanced right above. It's a graduated scale, but it gives the concept across. And above 80 is a buyer's marketplace, which we spend very, very little time in Silicon Valley. So the fuchsia line down here is your median days of unsold inventory. And the thing that stands out is this dip down to zero. How can that possibly happen? It can't. The MLS decided that in their wisdom not to discourage consumers from putting their house on the market, froze the days on market during shelter in place initially. I think it was basically from the announcement of March 17th through about May 17th. They didn't count days on sold inventory. So basically what this is telling you is 50% of the homes were listed in shelter in place and sold in shelter in place. And for those in the industry, it was sort of interesting because until May 1st, we weren't supposed to be showing those properties. So how were they selling? And you could show vacant properties, but people were showing occupied properties, even though they weren't supposed to be. And I think we have more compliance now that the rules are a little bit more tolerable. This is looking at the frequency and magnitude of overbidding. The lower line is the frequency of overbidding, and you can see that it's rounded down a little bit. Again, that doesn't particularly concern me. Anytime you're at 65% of the sellers are getting overbids, that's pretty significant. The top line is your magnitude of overbidding. And again, anytime you're over the red line, you're in a strong seller's market. Between the two, red and blue, you're balanced, and below the blue, you're into a buyer's marketplace. And you can see the two are pretty close in agreement. You basically got right below the blue line down here on the frequency of overbidding, and on the magnitude you were right at. Same here, right at and below. So these are just reference points that I've come up with. I think they're reasonable. This red line should be right at 50. That one should be at 33. So this one's off. That's at 99. That looks correct. That's at 101.5. That looks correct. And the reason, they're just arbitrary, but they're things that seem to work pretty well for me when I'm analyzing the marketplace. Now what we're doing is we're trying to average out the data. We're looking at a 12-month moving average. So this is what the inventory is, the blue line, for the last 12 months. And if you look at that, you've basically been flat, and that's so flat, I'm going to go back and look at the data to see if it's accurate. I would have expected it to actually trim down a little bit. The other lines look normal. I'll have to investigate that one. But basically, you can see we had a huge inventory right here in the middle of 2019, and the market was slowing down, but then you can start seeing it improved. So that's what it's sort of doing. It takes rid of the annual cycle. So here you can see the huge inventory that we had coming out of the 2007 recession. You can see that we got rid of that inventory. You can see we started losing inventory going halfway through 2017 when the market got on fire. Then you can see the market turned around and started slowing down again in the second half of 2018, right up to about the middle of 2019. And then the market started to improve again, and now it continues to improve. Then the next line I guess we'll look at is the number of offers. This is the red line, and this is where you can start seeing the trend. This is a 12-month moving average, so it's pretty accurate. But I mean, look at that, down, 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 fewer and fewer and fewer. Okay, now the rate slows, but it's still a downward trend, and that's what I was talking about. That downward trend has been going for 20 years now, and the valley's been expanding, so you have more houses, but you're selling fewer units. How's that possible? People are staying put in their houses for longer and longer. A large reason, Prop 13. As the dollar amounts get bigger and bigger, the annual savings on property tax is bigger and bigger, giving people a bigger incentive to stay put. I think we may see a fairly significant change in movability and increased transactions starting basically this week. Because if you put a house on the market now, market it for a week or 2 weeks, take a 35-day close of escrow, close on April the 1st, April the 2nd, you now have the new rules. And I think we're going to start seeing more activity. And you can see that we've had more activity halfway through 2020. And the reason for that is shelter in place. It has changed the basic fundamental needs of consumers. And so more consumers now are moving. They could have stayed put. Now it's not tolerable. They have to move for whatever the reason is. And so, boom, we're having an increase in sales. And I expect this increase, frankly, it should be leveling off because of shelter in place, but I expect it now to increase because of Prop 19. Let's move on to closings, the gold line. That follows the same pattern as the red line, but long term, you can see the number of offers is higher than the number of closings. So when the gap is big, you have a high TFT ratio, and you can see and TFTs are transactions that fail. You can see it gets smaller and smaller, and here it basically got to zero when the market was actually on fire. Then the market sort of stabilized and it increased again, and it's getting pretty narrow again. So that's a measure of how much TFTs. Now that's an underestimate because I'm doing offers for a 35-day period of time. So if a transaction falls apart in 3 days, it only counts as 10% of a transaction. If it falls apart on the 34th day, it counts as 97% of a transaction. So you can see that we do TFT a fair amount. Back here, based on that, we were TFTing roughly a third of our offers. I actually think, based on more detailed analysis I've done in the past, it was actually over 50%. It was under 2/3 falling apart. So it's probably somewhere around 55, 60% of the transactions that were started failed when we were in the height of the TFT ratio. And when that happens, you clearly are in a buyer's marketplace because buyers are willing to walk away from a transaction because they feel they can get a better buy. When you're in a hot marketplace, that doesn't happen. And finally, we're looking at the days of unsold inventory, and that's the leading indicator. That is not a 12-month average, which is why it's so jumpy. But you can see coming back here to 2017 and 18, it was on a very low number, and that's where we are now. In fact, you're almost a record low. You got a little bit below here. You crossed over into something like 19 and a half days of unsold inventory, but we're flirting with being the fastest marketplace we've ever had. In general, in single family homes in Santa Clara County, if you ignored Los Altos and Palo Alto, I think we probably would be outperforming 2017. I think the only reason 2021 is not outperforming is those what used to be the desirable areas now aren't so desirable, and that's slowing down the overall data when you look at it. Now we're looking at price. This is on semi-log paper, and the reason you graph it this way is you'll start seeing a straight line basically through a lot of the data points, and that slope of that line gives you the rate of appreciation. You can see the huge downturn that we had mostly in the affordable homes, much greater percentage wise here than in the expensive areas, and that was because of the 2007 recession. But basically, you can see the trend has been up. It's been fairly flat for the last couple years. If someone wanted to say in 2018 was sort of the peak and we've been flat since, that would be one way to analyze the data. I think what you had is overshoot and you have a slight climb, but people can differ on their take of the data. It's there for people to come up with their own. This is it on regular paper where you see it's harder to see the trends, but you can sort of see the flat. I think it's a little easier to see if you ignore this stuff right in 2018, which was the absolute crazy stuff, and just draw a line straight through here, I think we're a little bit better. But someone could easily argue that, hey, it's dipping down here. I could also go back and say it dips down a lot at the end of a lot of years. So I think that the dip down that we're seeing right here was that you're getting into the holidays, and holidays last year were less impactful than they normally are. But homes that sell tend to be smaller homes, and therefore the sale price tends to be lower. Not that the real property values decreased. This is doing the 10 percentile down here to the median. It's a ratio. Then the median to itself is obviously going to be 1, and then the 90 percentile ratio to the median. And what this does is it allows you to see basically right here in 2007, you had a price widening. You had the low end going down at the same time the top end was going up. So you had price spread. The lower end of the market was going down, the upper end of the market was going up. And now you're back into some price compression where we're getting closer together again. Here is what I normally go into, and this is what we're not going to do. This is what I'm reevaluating because of the MLS mergers. And I'm thinking of potentially looking at deleting the 22 micro market areas and just looking at single family homes in Santa Clara and San Mateo County and condos and townhouses in Santa Clara County, and forgetting about the 22 micro markets for weekly reports. And here are the URLs again, and that concludes my presentation, and I'm open for questions. Not seeing anyone unmuting themselves, I will call it a week and look forward to seeing everybody next week. Have a good week. Bye now.